Good morning, everyone, and welcome to the Moneycontrol live stream. You're watching another edition of Markets with Santo and CJ. Well, Paytm has been in the news. Yesterday, of course, the stock fell to a new record high, down about 75%. Twitter was awash with comments, mostly negative. But is the pessimism getting out of hand as far as Paytm is concerned? Is it about fundamentals now? Or is it more than about fundamentals?
Definitely
and that is
about fundamentals, but I'll
Santo,
get to that later.
I will also come to that later. But yeah, I mean, that is the debate that we have in the spotlight today. We are putting Paytm and the pessimism that has been surrounding, the pall of gloom that has been surrounding this company ever since it made its debut in November 2021. Now, Santo, of course, we know that it's the worst performing large IPO. Yesterday, Bloomberg came out with the story indicating that it's the worst performing large IPO in more than a decade anywhere in the world. So clearly that is not really a sort of a milestone that you want to achieve as a company. But here we are, Paytm is down 75% from its IPO price. Pre-IPO investors are trimming their stake. Largely, the recent sell-off is largely driven by that, of course, and also fears of some, bit of competitive intensity rising in the sector, possibly with the possible listing of Geo Financial Services not so long from today. So overall, it seems like this company is down and out. It's almost reminds me of the Amazon story, Santo, when the stock was down 90% and the Jeff Bezos was almost wondering whether he'll survive to see the next day, right? It almost seems like that sort of a situation. But is it really? If you look at what brokerage firm Citi has to say, they believe that the current valuations and the risk that they are at this point of time projecting are totally overdone. The brokerage firm is of the view that the pessimism on the street is almost getting out of hand at this point of time because the fundamentals are totally indicating a different picture at this point of time. If Paytm was not Paytm, if Paytm was some other smaller mid-cap stock, for example, a company whose losses are narrowing on a quarter-on-quarter basis, most of the operating metrics are becoming better, it's gaining market share. One of the most lucrative divisions that it has, the financial services division, is actually contributing more to its business than ever before. That stock probably would have tripled in its stock price value by now. But because it is Paytm, maybe it is not. So that is the question right now. Have the valuations become so depressed because of fundamentals of the company, or because of what the perception of the company is in the market? We know in the short term, sentiment and perception drive prices more than fundamentals ever do. In the long term, of course, prices will always remain slave to earning. And I think, Santo, given the fact that the fundamentals of the company are improving, in the long term, the depressed valuations are not going to hold. The stock is likely to see a reversal, and once the selling pressure from the pre-IPO investors is over, I think that reversal may come very soon.
Well, I'll agree on one thing, CJ. There is a lot of pessimism about the stock at this point in time, and typically it does happen that when there is too much pessimism in the short run, there is usually a bounce back. We saw that even in the case of Paytm in the initial days of its listing. The stock had quickly fallen to about 1300 odd. From there, it saw a pullback to 1800. More recently, we saw it in the case of SBI cards, where the stock fell below 600, and then there was a sharp pullback. So you will see those periods of pullbacks where pessimism gets overdone, and then one section of investors feel maybe there's some money to be made in the short term. You could see those pullbacks. But again, if we were to talk about the slightly longer term picture here, now companies making losses, which is fine. Probably Zomato also makes losses. But the comparison here, let's say if I were to compare a Paytm and a Zomato, is that the market in which Zomato operates is a two-player market still, right? At some point, it will have very strong market share. It already has market share,
almost
market share, and it will be
share,
able to increase its improve its operating performance simply because there won't be too much competition. Now, in the case of Paytm, right? If you what is the business model? What is so unique about Paytm that probably you can't get in some of the other stock? If you take at lending, for instance, there are enough NBFCs which are available at far more reasonable valuations, right? Lending is the big area for Paytm at this point in time, but you got plenty of other names as well. There is nothing unique for which market needs to pay a very high valuation, right? It's not that it's a bad business, but a business at what price? How much is the market willing to pay? I think it boils down to that, which is why I'm a little skeptical, CJ. First of all, the company will have to adhere to its timeline, which it has set for break even. After that, it needs to show some solid performance, because unless you are saying that look, this is a business where I don't have any competition at all, and at some point I will be the only player or among the 1 or 2 players left standing. Market won't pay that kind of fancy valuations as it was willing to pay last year.
I think, Santo, I think the question of fancy valuation is totally out of, it's not really even relevant here, because at this point of time, it's not a question of a reasonably valued stock trying to become a fancy valued stock. It's a question of a depressed valuation becoming reasonable, at least. At this point of time, what seems to be the case with Paytm is that market is not even willing to give reasonable valuation, because if you look at it even in terms of price to sales, I think when it listed, it listed at somewhere around what 20 to 20 times price to sales. The initial phase of correction brought it down to about 5x, 6x. Now I think it's below 3x. And if you look at any other peer of Paytm out there globally, at this point of time, I think Paytm might be actually trading at a discount. Even if not, the reason why Paytm was valued at a premium is, first of all, in internet we have seen it in across the sectors. You talk about social media, you talk about search engine, you talk about e-commerce. The first mover and the winner always takes it all. Internet is not your nuts and bolts sector. The dynamics of internet, which a lot of the so-called value investors of the 90s don't understand sometimes.
I see whom you are trying to get back at, but I'll let that slide.
Yeah, but it's always, the dynamics of the internet sector are totally different from what it is for the nuts and bolts sector. Yes, of course, at the end of the day, cash flows will matter, operating profits do matter, net profits do matter, nobody is denying that. But market share gains are generally tend to go to those who make the first move, and also who have almost all the gamut of services. That is what Paytm is ultimately boils down to. They have the first mover advantage to everybody else in the industry. And so far, they have been able to hold on to the business that they have. In fact, especially in the case of lending, they're actually now expanding their footprint as much as possible they can. And so far, they have not faced any sort of competition. The perception is the competition could come in, but they have not faced as intense a competition as, say, a lot of the other sectors are facing, where valuation actually remain quite reasonable. And another gripe that I probably have is that a lot of portfolio managers you will see on Twitter and all, talking about the fact that the management has somehow misled investors in terms of valuation. Now, guys, this is not a stock that was, shoved down your throat. When the IPO came, priced at 2,150 rupees, it was the investors who purchased the stock. It was not the management which went and threw the stock into every house and said that you will have to hold on to it. So do not say that the management has misled you. You yourself have misled yourselves. It's not the management. If the reason you're sitting on 75% losses because you purchased the stock in IPO, it's only you, because at that point of time, you believe that the stock was worth that much, right? You did not think that the stock was worth less, or else you would have not purchased it. So do not blame the management for the losses that you are seeing on your portfolio. The management took the decision in its best interest. You took the decision in your best interest. They turned out to be winning, and you ended up losing.
Now, that's the whole point, CJ. That's the whole point. That's what the market is very angry about. And someone who always talks about the wisdom of the market, here's the market's verdict for you.
Absolutely. And there is nothing wrong in it. The market showed the management that you were wrong, but that does not mean that the management misled the investors. To suggest that, the promoters should be behind the bars because they sold their shares. I mean, in that sense, no company ever should come onto the market, because it's not like every IPO that has come out in India in the past 10 years or 20 years has been making great amount of money out there for investors. So please, I mean that sort of virtue signaling has to end someday or the other. That said, moving on, let's look at the trade setup of the day. And before the bell, it looks like we are set for a muted start after hitting record highs on a closing basis yesterday. Of course, after 13 months of wait for the Nifty and the Sensex, it looks like we're going to have a little bit of a tepid start, and that is largely probably down to the fact that we did not have any cues from Wall Street overnight, because Wall Street was shut on account of Thanksgiving holiday. But if you look at the rollover data, Santo, that was pretty strong. Almost 82% rollover for the Nifty 50 on the futures side to the December futures or December derivative series, clearly much higher than the 3-month average. Also, very interestingly, FIIs at this point of time are now carrying long positions, the highest amount of long positions on the Nifty futures that we have seen since June 2021. So clearly, there is a lot of optimism from FIS side, and that generally tends to be quite a good signal if you're looking at future returns.
Well, the market is at a new all-time high. You've seen first the Bank Nifty make it, then you saw the Sensex yesterday make a new record high, but that still as I've been saying, is not really good news for a lot of people because the portfolios in general have not performed. And if you see, CJ, rates continue to rise. The pace of rates may be slower, but rates are continuing to rise. We'll still see the impact of that hitting companies, reflecting in their earnings. And so the earnings outlook at this point doesn't look very great to me. You could see again the market make some highs, but that's of, I would say, cold comfort to most investors. Now, getting on to FNOQs, we are seeing unwinding of long positions in Idea, Biocon and Alchem, and we are seeing some long build up in futures of Birla Soft and Persistent Systems.
Well, thank you for those FNOQs, Santo. Moving on to the newsmakers of the day, and both of our newsmakers are actually from the pharma sector today, Santo. But starting off with Lupin, so some bit of bad news coming in for the company. The company's another unit of the company has now received a Form 483. Basically, it's a ticking off from the US drug regulator, that is the US FDA. Now, the unit that has got the Form 483 is the Mandideep unit of the company, which has got 8 observations. Basically, the auditor from the US FDA who went to inspect the unit found about 8 violations at the plant compared to the good manufacturing practices that the drug regulator has. Now, clearly, this is indicating that there is an element of rising risk on the regulatory side for Lupin, and given the fact that the company was looking to launch a large number of products going ahead into FY24 and FY25, this could be a minor setback for those plans, Santo.
Well, and Laurus Lab is my newsmaker for the day. Now, the company has made an investment, not a very big investment, though. It will buy 26% in Ethan Energy at 52 rupees 70 paise per share, and it's buying about close to 7.5 lakh shares in all. So the investment is just about 4 crores, but what it does is that it will Laurus Lab will be able to use 100% output of Ethan Energy's 10 megawatt solar plant, and this should give some relief in terms of bringing its energy costs down.
Well, moving on, Santo, your top brokerage bet of the day?
It's SBI Life from Citi. Citi has a buy rating on the stock with a target price of 1,775. According to Citi, one of the key reasons for the bullishness on the stock is that the brokerage expects SBI Life to improve its market share in the months ahead. Also, the traction in volumes is likely to be led by new product launches. Besides that, Citi says that SBI Life is increasing the proportion of non-par products in its portfolio, and that should help it improve its overall margins as well.
Well, my brokerage bet of the day would be KPIT Technologies, a report coming out from Goldman Sachs today, basically on the back of that Renault deal that the company had won, and we had talked about it on the show yesterday as well. So Goldman Sachs has retained its buy rating and has given a target price of about 930 rupees. They believe that the Renault order is actually the first $100 million plus category opportunity that KPIT has now secured for itself. The deal could generate as much as $25 million on an annual basis over the next from FY24 to another 4 years. So clearly a very big opportunity coming in for KPIT Technology, and Goldman Sachs is of the view that this deal adds to the confidence of the management's own target of coming to the run rate of about 20% annualized growth in its revenues going ahead. So clearly a very, very important deal, a very, very important trigger for KPIT Tech. The stock had already risen about 4%, 4.5% in yesterday's trade, and it'll be interesting to see how it performs in today's trade as well, Santo.
Well, and with that we move on to the stocks on our watch list this morning, starting with Coromandel International. The stock had a good run till about a couple of months back, and since then it has fallen a bit because of profit taking. Now, the near to medium term outlook on the stock continues to remain positive. One of the reasons for that is the company has been able to improve its market share in the fertilizer segment. Now, fertilizers consists of about 85% of Coromandel International's revenues, and it's improved its market share there from about 15.7% in FY21 to about 16.7% in FY22. Where it's doing particularly well is the complex fertilizer sector. There the market share gains have been much higher, and also let's not forget that the government is trying to promote the use of complex fertilizers, trying to convince farmers to have a balance of nutrients so that reduce dependence on urea. Well, with that the market has opened. Let's take a quick check. Nifty up 18 points in early trade. Market breadth as usual is quite strong in the
So we had,
opening.
I think it looks like we're inching towards another record high. So it's been a decent start, not as negative as we, the exchange Nifty futures were indicating, but yeah, we are inching again towards, we are somewhere around the flat line at this point of time. The Nifty 50 index up higher by about 0.1%, but the mid and small cap stocks are doing quite well. The Nifty mid and small cap index, I think, higher by about 0.3% and 0.4% respectively, Santo.
Well, continuing on Coromandel International, now see 85% comes from fertilizers, but 15% is coming from the crop protection chemical segment, and that is where the bigger catalyst is, because it's got more pricing power out there. Besides that, the company is also focusing on organic fertilizers and specialty nutrients, two areas again where the growth has been pretty good. The company has also increased its guidance, which is that fertilizer EBITDA per ton to about 5,500 from 4,500 for this year. So overall things looking good, although there is some bit of profit taking, but this is definitely a stock to keep an eye out for.
Yeah, Santo, I think the second quarter earnings clearly, I mean, as far as the analysts are concerned, they remain quite happy with the company. But there is a little bit of a, concern in the near term with respect to the margins of the fertilizer business, especially Motilal Oswal is of the view that the margins of the company will remain under pressure in the third quarter as well, largely because of the fact that the raw material costs or raw material prices at this point of time for a lot of fertilizer companies have become quite volatile. At this point of time, one is not seeing any sort of trend in the sense that whether prices are trending upwards only or whether they are trending downwards only. So I think it could be possible that Coromandel could also be holding on to a little bit of high cost inventory on the raw material side. So that could possibly put pressure on the margins in Q3. That said, Motilal Oswal has also cut its earnings estimate for FY23 as well as FY24 on the back of a lower forecast for the company's margins in the fertilizer business. So clearly, while the overall long-term picture looks quite solid for Coromandel, some bit of near-term pain could be felt on the margin side in the third quarter. Moving on, my stock of pick of the day, of course, would be Kirloskar Ferrous. Now, this is largely a technical pick coming out from the stable of GEP Capital. Now, they noted that the stock had recently given a breakout after making a double bottom formation, Santo, on its technical charts. Generally, a double bottom formation tends to be a bullish reversal indicator. It's always been a very good sign as far as technical analysts are concerned when they have to see a long-term trend in a stock. And also, another pattern that the stock is making on the technical charts is the fact that in the entirety of November so far, it's been making higher highs and higher lows. So clearly that is always a good indicator for the company, for the stock's performance overall. And GEP Capital therefore believes that there could be as much as 19% upside on the stock, with a target price of somewhere in the range of 380 rupees in the coming weeks. So a technical pick to look out for in the market for the traders out there.
Well, even on the fundamental side, the story does look quite decent. Steady increase in earnings over the last many quarters now, and even on a longer term basis. So for instance, over the last 3 years, the company has grown its earnings at 19% compounded, and it's grown its top line at 19% compounded, and its revenue, its net profit at about 59% on a compounded basis. So clearly, the recent run up in the stock price seems to be justified on the fundamental side as well. The last stock on our watch list this morning is Uflex. Now, the second quarter numbers from the company was a bit disappointing, largely because of a sharp fall in margins. Now, the company's aseptic packaging and aseptic packaging segment has been doing pretty well, but the main area where the concern is, and which consists of a larger portion of its revenues, is the packaging films thing. So while the aseptic and flexible packaging segments both have been doing pretty well, in fact the aseptic segment, it reported an increase in revenues of close to about 145% year on year. In the case of flexible packaging, the growth was about 24% year on year, but in the packaging films segment, that's where the pressure really has been. However, the management is confident that things will start looking up from the next quarter onwards, and according to management, the growth in the aseptic film segment, that is about 18 to 20%. The industry is showing very strong growth, and that is where the major kicker is likely to be. Valuations are also fairly reasonable at this point in time. According to Moneycontrol Pro, the stock is quoting at close to about 4% FY24 earnings, which is not all that expensive.
Well, probably long term, I think Uflex has been a very good story so far in the market, and overall going ahead in the 4 to 5 years as well, the overall expectation from the company is quite high. But recently the stock has come under a lot of pressure. If you look at the recent performance, I think the stock is not doing that well, down about 14% in the past month. 4% this past week as well, and some of the technical indicators are also not giving a very good reading. The RSI is down at about 21.5, money flow index at 22.1, so clearly there is a lot of pressure. The stock is also trading below a 200-day moving average at this point of time, which is generally, even if there is a little bit of a bounce back on the stock, I think that is unlikely to sustain, because you could see some bit of some bit of sellers trying to sell on the rise and get out of, or cut out their losses on discounters. So overall, the longer term story remains quite intact, but at this point of time, it seems like on the technical side, the near term could be still under pressure.
Well, and do we have any questions for today, CJ?
Yes, sir. I think some questions coming out on Arvind Limited. This is one stock Vinayak Shenoy wants to have our thoughts on. Any thoughts on that, Arvind? Santo, it's basically Arvind Fashions is this play here. We've largely been in the apparel space, and I think, if I'm not wrong, their earnings overall had been quite good. Although recently the stock has come off quite a lot from the cliff. I mean, it was trading as high as about 370 to 390 rupees at one point of time back in earlier this month, but since then the stock has seen a little bit of an underperformance. I think overall this sector, the entire apparel sector, benefited a lot from the pent-up demand. Of course, the return to school, return to offices, travel demand being high, that did lead to a lot of earnings improvement for these stocks. But now I think there is a realization within the market as well. There are a lot of that pent-up demand is probably going to fizzle out very soon, because of course you cannot keep on replenishing your wardrobe time and time again. We have seen that happen with a lot of footwear companies as well, such as Relaxo, Campus Activewear, which were very much in demand in the first half of FY23, but seems to have been now pushed back on investors' buying lists. So overall, if you look at promoters have been decreasing their stake, mutual funds have been decreasing their stake, and although FIIs have been slightly buyers, but not to the extent that could affect the stock at this point of time, and therefore I think in the near term the stock could remain a little bit lackluster.
And very interesting there, because the earnings, there's been no deterioration there actually. In fact, they've been quite steady for the last 4 quarters now, but probably the market now seems to be, at least that's what the price action seems to be indicating, is that the market feels earnings are unlikely to get better than this, and that probably explains why the stock is seeing a lot of profit taking at these levels.
Santo, on that note, we can wrap up the show.
Well, thank you for watching and also sending in your queries. If you have any queries, please do send them across and we'll try to address them.
And guys, keep following us on the social media links that you can see at the bottom of your screen. And for rest of your financial news, stay tuned to Moneycontrol.com and download the Moneycontrol app. We'll catch you again live at 3 p.m. with all the day's trading action. Till then, have a great day.